Hello and welcome to this week's episode of the Scottish Property Podcast. My name is Stephen Clark and I'm joined as always with my co-host Nick Ponte. How you doing, Nick?
I'm good, Stephen, thanks. Yeah, we've got a good one lined up for you today. We've got accountant Brian Wright, recorded an interview with him all about the pros and cons of investing through limited company. Now, this is a question that is an old question. It pops up again and again and again. But the reason why we wanted to do a podcast on it is because we basically think that people need to do this right from the start. It's crucial that you get this lined up correctly and get yourself structured properly right from the start, isn't it, Stephen?
It's hugely important. I mean, this is the foundation of everything you're going to do, but you need to make the decisions with all the facts on board about where you're going to go with your property journey, what you're going to be doing, and have all that set up in front. And I think Brian ran through about 14 points that was a great roundup of everything you need to consider, which is a lot. And I'm going through the struggle at the moment, selling properties in my own personal name, restructuring the kind of companies that were set up in it that should have been in a group and stuff. So it's hugely important to get it right up front. If not, it's going to cost you thousands of pounds later on down the line trying to fix it.
Yeah, and obviously Section 24 has taken its full bite this year and it's 100% now phased in. So people who are doing their tax returns are going to start noticing this if they haven't thought about it before. If you're holding property in your personal name and you're a higher rate taxpayer, then you're really going to notice the effect of Section 24 in this year's tax returns. So listen to the podcast. I hope you find it useful. And as always, give us any feedback and we will cut to the interview with Brian Wright. Okay, Brian Wright, welcome back to the Scottish Property Podcast. Now, we actually had you already on episode 27. We did a chat about bounce back loans, and since then I've been hearing in the news that there's major police investigations and that into bounce back loans, and I think we touched on that at the time, that people were misusing these things. But today
Brian's sitting there with a smile on his face like, yep, I warned you all.
I think Lamborghini sales and Ferrari sales have gone through the roof, haven't they? People just buying cash. Have you seen anything just while we're on that subject?
Well, other than that guy that posted the story about somebody else had taken a bounce back loan on his behalf, the guy from the car company that went viral around Facebook at one point.
Yeah, that's right. Anyway,
you have to take your hat off to these entrepreneurs, don't you? Thieves or otherwise.
I think you hinted at about it right at the start as well, with the furlough scheme is rife with fraud and that going on as well at the moment. So there's just so much money out there that's potentially in the kind of hands of the wrong people, basically. Anyway,
so today we're discussing the kind of common age-old question that we get asked a lot on the Facebook group pages: should you invest in a limited company or in your own personal name? Now, a lot of podcasts have covered it, we've covered it, but I thought it'd be good to do an episode on it to kind of cover it, that we can refer people back to, because it isn't quite an easy, simple yes or no answer which way you should go, is it, Brian?
No, extremely complicated, as I was explaining earlier on. I've listed about 14 issues that you need to be aware of when you consider how you buy your buy-to-let properties in limited or otherwise. It's not simple, and it's not a one size fits all.
Can you first just tell us a little bit background to Section 24, what exactly it is and why we should consider investing through a limited company and where we're at with it now?
Okay, so Section 24, or Clause 24, refers to one of the Finance Acts. So Budget 2015 introduced this whole concept of restricting your ability to deduct mortgage interest from your rental income. That was introduced in April 2017, and over a period of 4 years reduced 25, 50, 75, and now 2021, 100% of the interest that you can offset against your rental income. So effectively what it means is, in calculating your rental profits, you have to exclude the mortgage interests in the first pass. So it might mean that if you're a higher rate taxpayer,
taxed on turnover rather than profit then.
Yes, I mean, the only things you really get to take off are things like repairs and maintenance and letting agent and equivalent type fees. And of course, the biggest cost that you have generally in property is the interest on the loan. So the fact that you're not allowed to deduct that is quite penal. And it means that people will be suffering tax at a rate of 41%. However, there is a section within that, the new legislation, that a lot of people forget about, and it is worth mentioning, and that is, regardless of your tax rate, you are still entitled to a 20% tax credit. So if you're a 41% taxpayer, you will still get 20% back. If this is going to guys in England as well, remember they're on 40% higher rate tax and 45% highest rate tax. In Scotland, we are 41% and 46% respectively. So if you're on a 46% tax rate, you'll still get your 20% tax deduction if you're on 41, likewise. And if you are a low rate taxpayer, you'll not see any sign, although you technically pay tax in first pass at 20%, you also get a tax credit of 20%. The exception to that rule is that if you have a rental loss, you don't get a credit, which then results in a tax credit. What you do is carry forward the loss that's created by the 20% tax credit to future years. So you do get it, you just have to wait until the cash flow sorts itself out.
Okay, that's interesting. So if we're a lower rate taxpayer, i.e. Earning under 45?
In Scotland, £43,430, and in England, £50,000.
Okay, so if you're one of these people and you're thinking about getting involved in property investment and getting a few buy-to-lets, and you're saying basically you won't actually notice a difference. So why would you consider then thinking about setting up a limited company to invest in? Give us some of the things, if you're new to this and if you're lucky enough not to actually have any buy-to-lets just now, because I think that it is, people who are kind of like, I've already bought like 4 or 5, they're kind of in that kind of position where they don't know how to transfer them over. It's so costly. And then, moving forward, what do they do? So give us a wee idea of why they should think about doing it.
Okay, let's just talk at the outset the real issues here, which are unique to property and unique to property investment, and they don't really have an impact on any other type of activity, other type of business. And that is, you have with property capital taxes, and capital taxes are capital gains tax, and in Scotland, land and buildings transaction tax, in England, stamp duty land tax, and the rules for land and buildings transaction tax, which is LBTT for short, and stamp duty land tax, SDLT. There are differences. So if you're operating south of the border or north of the border, please make sure you speak to the right people to get the right advice on that. It's pretty complicated. And the second thing, of course, is that outside of property and land, nothing else actually gets registered on a public register, really, does it? So nothing else really requires a lawyer to register title. So these are the issues that are unique to property investment, property ownership, and they cause huge problems. So that's the starting point. Now I've scribbled down 14 items. I think it's 14 items, and I'll run through them quickly, and we can pick up any of the ones you want to pick up. So here goes for my list. So the first issue you need to consider is the current salary you're on or income level you're on, as to whether it's lower, higher, or highest rate tax. The second thing you want to look at is, what are your medium-term plans regarding your existing earnings, your existing job? Do you wish to continue or not? Number 3, do you have a spouse? Are you married or not? Number 4, what are the earnings of your spouse, higher or lower rate? Number 5, do you have any other limited company vehicles for restricting income? Number 6, what are your long-term plans, and how certain are you of your current strategy? Number 7, what risks do you foresee with your existing assets or any assets you might buy through the new property venture that you're starting? Do you have any legacy issues? Do you have any children, and what age are they? Number 9, are you going to be using investors to finance your deals, or are you going to be using banks? And if you're going to be using banks, are you going to be using mainstream lenders, or are you going to be using specialist banks? Number 10, Do you have any issues with tax mitigation? And have you compared the costs of saving the tax with the professional fees? Number 11 is to do with lending, so bank lending and the legal costs of doing so. Number 12 is the lending itself and the fees the bank might charge. Number 13 is lending rates that the banks might offer inside or outside of a limited company vehicle. And number 14 is the leverage that you can achieve using banks and other lenders, whether you're inside or outside a limited company. So as you can see, guys, there's a huge list of issues to go through. There's probably no chance of getting through all of them today, but just to let listeners understand that this is not an easy discussion or an easy decision, and sometimes it takes 2 or 3 discussions to get to the bottom of the right strategy.
It's one of the main points, Brian, your end goal with your property portfolio. Like, I mean, I'm assuming to go over the £44,000 income, and if that increases over the years, then if you're going to have a small and medium portfolio, then it's not a huge issue. But if you're aiming for a larger portfolio, it's going to make sense to put in a limited company straight away. So does one of these important issues start with your goals and aspirations for it?
Absolutely. So if you are dead set that you're going to build a portfolio of 10, 20, 30, 40, 50 buy-to-let properties, I think it's a no-brainer. Mm-hmm. The big challenge I have is lots of people come to the office here, or I meet them in the various courses that are run, and they think this is going to be their strategy. They're relatively new to the property game. They don't actually appreciate what other options there are out there. And so they just go
involved in it.
Correct. Mm-hmm. So as a consequence, and we've been in business now doing what we do for 17, actually going on 18 years now, believe it or not. And the number of people who come to us a year or 2 years after they've started saying, well, actually, we've decided that buy-to-let, for example, doesn't cash flow enough. So now we want to look into things like HMOs, or we want to look into service accommodation or short-term accommodation, or indeed they've decided they want to do flips and small developments. This is the problem for new people coming. What do they do now and in the future?
That's probably a nice point to touch on. And I'm assuming you mentioned flips and different investment strategies. These are kind of often have to be in different limited companies as well, separate from a buy-to-let limited company. Is that right, Brian?
That's correct. Now, I think it was in 2015 there was a change in the corporation tax rules, and introduced in 2017, something like that. Please don't quote me on that because I haven't checked it out. And that meant that within a limited company, you could have multiple streams of income and you could offset one against another. Although good accountants will separate them out for the purposes of proper monitoring of business performance. However, the big issue with that, Stephen, is the fact that banks are particular about what they lend to and how they lend. They talk about an SPV, a single purpose or a special purpose vehicle. And what they mean by that is because the banks lend on the basis of risk, if there are more than one type of activity going on in one company, they can't correctly assess the risk. So rather than do a complicated actuarial assessment of what the risk is, they'll simply turn around and say no. And so for people who are doing flips and investment in the one company, the likelihood is if they are going to be using a mainstream lender, they're going to come into difficulty with who's willing to lend, if at all, to them.
It's a really good point, actually, Brian, on and you mentioned it on your 14 points as well. And a lot of them is a difference between the cost implications from a limited company and a personal name. Now, lending is one of the ones that you did touch on. Lending, brokerage fees, arrangement fees, exit fees, and interest rates at the moment are still a lot higher than a limited company than in a personal name. So that's something well worth factoring into your costs as well before making that decision as well.
That's right. Well, we had somebody in the office who was considering limited versus not limited, and we looked at, say they did 4 deals in a year. So you're going to have lending and legals was 0.11. So you're going to have potentially 2 lawyers. Now, I believe there are 1 or 2 banks who will accept 1 legal person only nowadays. I don't know who they are. However, most banks will still insist that you have your own representative as well as their representative, which means you've got 2 sets of legal fees because, of course, the bank will recharge their lawyer's fees to you. You'll have your own lawyer. So and I think the average fee nowadays is around about £800 to £850 for the legals for conveyancing. So there you are, instead of having, so you've added £850 for 4 deals. So that's £3,300 extra in 1 year just for doing something in a limited company. As you say, the arrangement fees are higher. I think typically the arrangement fees might be an extra £500 or thereabouts for a limited company. There's another £2,000 for that in 1 year. So it's not long, you're now over £5,000 worth of extra professional fees before you get started. The other big thing about limited versus investing in your own name or borrowing in your own name is that the leverage is generally worse. I think, again, there are 1 or 2 specific banks who will lend at the same kind of level as you might get if you invest in your own name. But because limited equals commercial for most banks, typically you're looking at lending rates of 60 to 65% loan to value rather than 75% loan to value, which you can get in your own name. So again, you've got to think about far bigger chunks of deposit that you're tying up for a period of time until you can get that money back out again. So, and that's a cash flow, but potentially a real cost issue for those investing through a limited company.
So obviously the lending there, one of the kind of disadvantages of investing through limited company, because it is that more costly and there aren't probably as many options available to you. So as we're on the disadvantages, can you give us any other disadvantages or cons for investing in a limited company? Then we'll move on to the kind of the pros and the advantages.
Yeah, absolutely. So generally speaking, and I can only speak for myself in this, but there are a couple of additional costs that arise from an accountancy point of view for limited companies. The first and most obvious is the fact that you will have a corporation tax return to do on top of your personal tax returns. Another issue that comes out is that because you're submitting to public bodies, in this case, Companies House, there are accounting standards to comply with, and that simply means a little bit more time for the relevant qualified senior accountant to look over your accounts.
It's something that I've learned very quickly, that you really need to be on the ball with that sort of stuff, because it's all very well, going on Companies House, setting up your company under, whatever name it is, because everybody gets excited about the logo and the name and all that. And it's all easy to go on Companies House. It's like £12.50 or something like that to set it up. But then quite soon after, you start getting letters through the post, and it's like, confirmation, what's it called again?
Confirmation statement, that's right. Yeah.
So you have to do that. You have to obviously submit the annual accounts and all that. And if you're not on top of that sort of stuff, and I quickly realized, then, it's going to cause you a major headache. And, things like bookkeeping and making sure you keep all your records, it's really, really important.
Absolutely. And I think, to be fair to most professionals, they don't overcharge for what they do. Most professionals are putting a pile of work in to get people over the line when it's going on to Companies House. I appreciate, for all of you guys, complying with accounting standards means nothing to you, and quite frankly, there is no benefit to you guys whatsoever. But it's a legal compliance standard, just like ISO 9001, and it has to be done. And unfortunately, the people who come to an accountant for help with their limited company have to go through that process. Now, the other thing as well, which you've alluded to, is the whole company secretarial service. And again, different accountants will do it different ways. We have both a flat rate fee and we also have a per item fee. But when it comes to compliance, the things that you've got to be aware of is, every time you issue a dividend, you should already have noted a meeting of the directors to declare a dividend, and you should have a dividend voucher. And not many people know this, so here's a little clue for those of you who have taken furlough payments as directors. If you don't have the appropriate shareholders EGM paperwork in place, theoretically HMRC can come and take the money back and charge you a nice little 100% penalty on top of it for not complying. So there's the compliance aspect. There's more to it than people realise. It's just that when you go, as you say, Nick, and you set this thing up on Companies House, whichever company name you've used, with whatever SIC code that people struggle with, and they think that's it. So why the hell is our accountant charging us more money for that? That's the reason. And people aren't going to do that effectively themselves. They are relying on a professional who does it day in and day out to do it.
Sorry,
And
Brian.
obviously, if you don't have your shit in order, then you will get fines as well. So I think, like, if you're late in filing your accounts, it's like 150 quid for the first month. It then shoots up to, like, I don't know what it is, a sliding scale, but you need to be on top of that stuff. Any other disadvantages before we move on to
Nick, just for the listener, can you explain what the SIC code is? Because I know that people maybe that are starting out maybe wouldn't understand what an SIC code is when setting up a limited company.
Yeah, thanks for that, Stephen. We use all these blooming acronyms in and out. When I first heard SA, I thought self-assessment. What the heck's that? And somebody went, duh, serviced accommodation. So you do have to learn all your... So SIC is the statutory industry code. It's a finite list of codes that's produced by the government to define the type of business and industry that you are in when you operate your limited company. And already, I mean, it was revamped about 4 or 5 years ago because Companies House realised it was full of trash, and it's already now full of trash again because we go on there regularly and look at some of the stuff that's on there, and it's laughable, to be honest.
What so does that, I mean, is that really important then? So like if I'm doing flips and doing property trading as opposed to like just, you know, building up investment properties buy to let, is that totally different codes that you need to set up then?
To the best of my knowledge and belief, Nick, I believe that only the banks will check it, and if what you have is wrong, the bank will refuse lending. Again, it's the old age where whatever the bank wants goes against what the tax authorities want in terms of benefit, and vice versa. So I think it's my experience is the only people that ever looked at it are banks, and they do study it and look at it.
Here, as we're talking here, I've got a good question just popped up on Facebook from Forbes Elder. Wee question for you, just to keep you on your toes, Brian. Can a personal property which is not owned by a limited company put the rental income through a limited company to pay corporation tax instead of personal tax?
We're actually dealing with a case like that right now. Difficult one. If it's in an early year of your business, then you might want to put it down to administrative error. However, reality is the income goes to whoever the title holder is. So if it's the individual who's the title holder of the property, then it should be through their personal tax. If the individual on the title is the limited company, then it'll go to corporation tax. And there is something called a bare trust, but I don't think that would be effective in this case in Scotland. You can have a beneficial ownership transfer from own name to limited company in England because they don't have a single title, they have freehold and leasehold, and HMRC rules are based on UK, and therefore to an extent some of what HMRC promotes still works, but in this case beneficial ownership transfer from individual to limited company in Scotland is not effective.
Well, that was going to be actually, you know, going on from that question, because I'm thinking to myself, well, you know, why wouldn't Forbes just get that personal property into a limited company? But obviously there's obstacles there, isn't there? Let's just talk a little bit about the obstacles and why that might, you know, you might want to think twice about that.
So the obstacles are the obvious: capital gains tax, land and building transaction tax or stamp duty land tax, and legal fees. These are the big obstacles.
How much is capital gains tax again? What are we paying there?
Capital gains tax at higher rate for residential properties is 28% and at lower rate 18%. However, it can be done if the gain is below, I think the current annual exemption is £12,300. So if the gain in the year for the individual in total, including any other gains or losses, amounts to 12,300 or less, then it could be done without capital gains tax. However, if there is a transfer from individual name to limited company name, that's an effective change of title and would be subject to land and buildings transaction tax. And as you know, the additional dwelling supplement that now exists,
4%,
the minimum is
4% basically,
4%.
plus any LBTT as well.
And your legal fees, of course, £850, potential additional.
You'll be paying it for your limited company and your own personal name, wouldn't you?
Yes. You've got bank charges unless the loan's coming to an end. And if you are doing it, then it would be sensible to wait till your loan's to be renewed. You're better renewing it, because otherwise you've got additional arrangement fees and reduced leverage and increased interest rates and all the things that come with that.
And what about this idea of getting 6 properties? If you're, for example, you've got maybe 4 properties in your personal name already. Some people have asked before, if you buy another 2 in your personal name, then if you've got 6, a portfolio of 6, can you transfer them over and avoid paying the capital gains or no?
Additional dwelling supplement?
Additional dwelling supplement.
Yes. So again, this is to do with land and buildings transaction tax, LBTT, or stamp duty land tax, SDLT. Yes, there is a rule for both, whereby portfolios of 6 or more, and this came down to a case a number of years ago called the Ramsey-Moyne case, effectively, that said it is viewed that people who have 6 or more properties and who do X number of hours in their business per week effectively qualify. So the land and building transaction tax rules kind of follow from that, and that is portfolios of 6 or more can then be treated as a commercial deal, and they can be transferred in using commercial LBTT or commercial SDLT rates. And so there is a potential saving in there. Yes.
So you would avoid paying the 4% then, but pay on a commercial LBTT, right? Okay.
That's correct. And indeed, there are also differences between England and Scotland in regard to something called multiple dwellings relief as well. I'm not even going to go there.
But you'd still be subject to the capital gains tax, right?
Again, if it's 6 or more, you can justify the number of hours you spend. Then there's a possibility of rolling the relief over. But the answer is potentially. Potentially.
Okay. Cool. Right, it's something to have a further conversation with your accountant about that. Then, if you're looking to go down that route. So, I think we've talked about a lot of the doom and gloom there and the kind of disadvantages of it. Can you give us any kind of hope? Obviously, there's loads of people doing this. So, why are they doing it? What are the advantages of it?
Well, first of all, if your long-term strategy is 30 properties in a limited company, you're going to restrict your tax rate to 19% currently. And there is talk about the tax rates for companies going up to 24%, but that's still a long difference away from 41 or 46%, isn't it, in Scotland, or 45% in England. So if your long-term strategy is a huge number of properties in a portfolio, then absolutely definitely a limited company is a positive because of the minimization of tax. That's number one. Number two would be one called legacy. So within a limited company, you can transfer tranches of shares over a period of time to your children, or to any other for that matter. And as long as you keep it below the capital gains tax rates, which of course is the stamp duty on shares now. It's not the stamp duty land tax or the land and buildings transaction tax. Stamp duty is at 0.5% on shares, so it's a lower rate of tax. And if you keep it below a certain level, then obviously the tax element is far lower. Capital gains tax is lower, and so on and so forth. So that's a long-term burner where you can transfer it to your children. Of course, if your children are very young, you can't transfer it. It would be ineffective. If your children are 18 years of age or older, you can transfer shares. But there are also other things like employing your children within the company. So you might be, as parents, you're going to give your kids a certain amount of money anyway. And if you give them money post-tax, you've suffered the tax on it, and so all that happens is you give it to them after tax. However, to the extent to which they are not earning, perhaps at university or the early stages of their jobs, you can actually legitimately employ them. You have to give them proper jobs to do, otherwise that would be a form of tax fraud.
Yeah.
Because you give them proper jobs to do, and you can then pay them a salary. So again, they can get income pre-tax rather than post-tax. So that's another benefit.
Stephen Clark's already got Maya out on the refurb sites, doing a lot of jobs to tidying up and all that. You've probably got a wallpaper strip in there today as well, Stephen.
She's already in the payroll, mate. She's already in the payroll.
Yeah, I saw that. By the way, if she's under 14, you do have to get permission from the school. Make sure you don't affect her academic
She's not even
studies.
at school yet. She's only
I know.
starting young and then
Yeah, I have noted that she's got a great work ethic, and she's only what, 4 or 5, what's
yeah.
she? Yeah, so brilliant.
I like to be
So
involved.
that's another benefit. Another benefit is protection of liability, of course. If you've got other assets that could well be exposed by putting all the property stuff into limited company, a third-party creditor couldn't go after anything other than the assets within the limited company. Again, it depends what structures you have outside of that. For some people who may be running businesses in their own name outside of that, then if your property stuff wasn't within a limited company, then potentially your other business could be at risk, or your personal assets at risk. There are 2 exceptions to that, one current and one, I think, in the offing. The first exception, of course, is that if a bank asks you for a personal guarantee, by default, you've actually allowed the bank to go beyond the limited company and take your personal assets in the event of default. And the other one, sadly, is HMRC is considering changing the legislation to make directors personally liable for tax debts. And whilst none of us are comfortable with that, I don't suppose we've got any locus of control on that one. So watch this space. But I think that any corporation tax debts or PAYE tax debts or VAT tax debts in the future will be the individual directors of the company may well be held liable for that in the future, in which case the protection is not there. But for every other third-party creditor, you will have the protection of legal liability, provided that all the directors have behaved honestly, openly, correctly, and not prejudice their creditors unfairly.
I've just thought about another advantage as well, obviously, that's just come about in the last sort of few months. I mean, with all the government support for businesses and that, obviously, if you've set up as a limited company, then you might well be eligible for, some of these grants, or, some of these cheap loans, bounce back loans, which we've talked about, obviously, in a previous episode, which are a bit controversial as well. But say what you want about the bounce back loan, it's basically cheap money. It's an interest-free loan for the first year, and then cheap interest rate for the next 5 or 6 years. So that's another thing that's come about recently.
Yeah, that's true. As long as the business is considered to be a trading business, I think you're fine with that.
Cool. I think that pretty much sums it up, Brian. I think you've done a cracking job there, keeping it short and sweet. I know we could probably go on all day talking about the ins and outs of it. I think what I've kind of gathered from our conversation is there's no kind of set kind of answer to the question, should you invest in limited company or not? There's, like you said, 14 different things that you need to consider. So it's a conversation that people need to have with their accountant or indeed yourself. So if you just want to give a mention how people can reach out to you.
Yeah, absolutely. I think the point just before I do that is this: please go and speak to your professionals. Please speak to your lawyers, speak to your accountants. These guys are doing this day in, day out. And if the chances are they'll get it right for you. And even if they don't get it right, at least they're backed by professional indemnity insurance. In the event that something goes horribly wrong, you have a comeback on that. I'm happy for people to come and talk to us. You can get us obviously on our website, www.fbdconsultancy.co.uk. We're all over the Facebook pages. We're all over LinkedIn. And I mean, they can get access to us through you guys. I'm happy to take referrals on for that. But just please go and check it out. Do a lot of thinking before you jump in there, and then you don't have the issue of having to backtrack. And I appreciate it's really, really difficult, but go to somebody who's doing this day in, day out, and they'll get it right for you.
So, guys, I hope you enjoyed the interview with Brian Wright and took some value from it. I know myself and Nick always do. Every time you speak to a professional like Brian, you do pick up little nuggets all the time, that does help you understand this kind of complex issue a lot more. How did you enjoy it, Nick?
Good, mate. Yeah, obviously it's something that I realised very quickly You need to be on top of this sort of stuff, and having a good accountant is crucial to your power team.
So guys, if you are interested in joining our next Monday night lockdown, it's not even lockdown live now, is it? It's okay now Monday.
Well, it is. We're coming back into lockdowns, mate. We're going to be back in lockdown.
Live again. So the next area and focus is this first Monday of November, which is landed on the 2nd of November, and this area and focus is going to be the city of Aberdeen. So who have we got on this week, this month?
We've got Chris Minchin, which is a letting agent up in Aberdeen, who you use actually for your portfolio to manage your property, Stephen. We're actually getting yourself as one of the guest speakers as well, because you're the man who's been you've been motoring up to Aberdeen pretty much every week, snapping up all the deals up there. So you're well informed to be talking about this market, and it's one that intrigues me. You've tried to talk me into buying up in Aberdeen a couple of times, and I just can't get my head around it. So I'm really looking forward to the chat. It's the only place in the whole of the UK that's still dropping in property values. But obviously, you guys are doing the business up there. You're picking up buy, renovate, refinance deals left, right, and centre. So we're looking forward to hearing all about it.
Yeah, it should be fun. So join us and register for the event where you can ask any of the guest speakers any questions live, and Nick can put them to the speakers of any questions you have concerning Aberdeen, investing in Aberdeen, letting in Aberdeen, where the market's going, what the market's currently like.
Great stuff, guys. Thanks very much for your support. As always, head over to the Facebook page where the discussion continues about the current COVID economic situation. We're trying to get a bit more kind of harder on the news over there, keep people informed. And if you do have a spare minute, please, if you could leave us a review, that would be really much appreciated. And we'll see you next week.
Thanks for listening, guys.
Bye for now.